Impact webinar.
Pause.
Hello, everyone, and welcome to the Planning Your Irish Impact webinar, where today we cover everything you need to know about charitable remainder trusts. My name is Leanne Tokars, alumna and morning news anchor at WSBT 22. And every year I help out with Notre Dame Day, and today I'm excited to be helping out with the Office of Gift Planning to share with you, fellow alumni, parents, friends, and family on one of the great opportunities offered here at Our Lady's University. I am joined by TJ Polari, Senior Director for the Office of Gift Planning. TJ has been with the university for 6 years, working with alumni, parents, and friends on deferred and structured contributions to Notre Dame, such as charitable remainder trusts. Let's dig right in, break down what a charitable remainder trust is, how it works, and answer all the questions submitted in advance by our attendees. Now, please note, if you have any questions during the webinar, please feel free to email pgiving@nd.edu. And if we do not get them answered during the 30 minutes, we will be sure to have someone from the team reach out and answer any questions you have. All right, TJ, let's get right to it. Many people are aware of the strength and power of the Notre Dame Endowment. How do charitable remainder trusts tap into that strength and power?
Yeah, well, first, Leanne, thank you so much for being with us today. It's great to be with all of you who are tuning in. Thank you for all you do for Notre Dame. This is a great topic to begin our webinar series with because charitable remainder trusts, or CRTs, as I'll refer to them throughout our conversation, are not only one of the most popular, powerful gifts that one can make to Notre Dame and have been that way for decades, but they're also a little bit tricky sometimes to understand. And as we work through the details, benefactors can sometimes get caught up in understanding how they work. So this is a great topic to really dig into. My hope during our conversation is that we can walk through how it works, simplify a little bit what that process looks like, talk a little bit about the benefits of a CRT, and hopefully answer the questions that our folks have that are tuning in. So let me say at the outset, before we dig into those details, anytime that a donor is considering a gift to Notre Dame, especially one that has an investment component, it's really critical that they consult with their own legal and tax counsel. We're going to provide a lot of general information today, but every situation is unique. And so to be sure, our conversation should not be construed as individual tax or legal advice. But yes, you mentioned the Notre Dame Endowment. And so let's start there. So the Notre Dame Endowment is such a powerful tool for many reasons at Notre Dame, but it is, to be sure, one of the primary reasons that folks will consider a CRT. And really, if we start at the most basic level, there are three common and really important features of a CRT that our folks should be aware of. So first is that a CRT allows you to personally benefit from the returns of the Notre Dame Endowment, and that happens through an annual income stream that Notre Dame distributes. The second is that a gift to a CRT makes one eligible for a partial income tax deduction in the year that the gift is made. And that's based upon a few different factors, primarily the amount of the gift, certainly the ages of the beneficiaries of the trust, and some other factors that we'll talk about. And then third, of course, is that a CRT is a means of providing a really extraordinary gift, ultimately to Notre Dame, that a family can direct. So three common features: participation in the returns of the endowment, partial income tax deduction up front, and then ultimately a really powerful charitable gift. So to dig in a little bit deeper, it works kind of like this. So you make a gift to Notre Dame of not less than $100,000. Typically, that gift is cash or publicly traded long-term appreciated securities. There are some other scenarios where other contributions can be made, and we'll talk about that a little bit too. But what happens is that Notre Dame receives those dollars. We invest them in the Notre Dame Endowment from day one. And then typically, if the donors are also the beneficiaries of that trust, which is typically the way that it's structured, Notre Dame will now distribute back to them for the duration of their lives an annual income stream. And then at the end of the trust, when the donors have passed away, the balance at that time we use to direct as the donor family suggests that we should.
Now, TJ, income, clearly a unique and valuable part of a CRT. Can you share with us how the amount of income a person receives is determined?
Yeah, so this is a great topic to dig into. I would say when we're talking to benefactors about a CRT, it's the topic that can cause the most confusion. So we should spend a bit of time walking through it. So there's a few things to think about here. First is that we start with what's called a unitrust rate or a payout rate, and that's a fixed rate that is set at the time that the trust is established and continues on with that fixed rate for the duration of the trust. So let's assume in a given scenario that we have a married couple that is under age 50 at the time that they create the CRT. In that case, the fixed rate, that payout rate, would be 5%. If that same couple is over age 50 but not yet 70, then Notre Dame could offer either 5% or 6% as a payout rate. And then if both of the beneficiaries in this example are over age 70 at the time that they create the trust, then Notre Dame could offer either 5%, 6%, or 7%, again in the donor's discretion. So we have this fixed rate that we start with, but the payout itself is variable. It's not a fixed payout, and that's because, as we talked about, the dollars in the CRT are invested in the Notre Dame endowment. So what happens is on January 1st of every year, we look at that trust and we determine what the value is. And then we calculate that value by the payout rate. So if we use a scenario, let's assume that a trust has a balance of $100,000 on January 1st of 2023. And let's assume further that the payout rate for that trust is 6%. So on January 1 of 2023, we're going to say, okay, the beneficiaries of this trust are going to receive $6,000 because that's 6% of that balance of $100,000. And Notre Dame is going to distribute that balance in 4 equal quarterly installments. But remember, the value of the trust is being invested in the endowment. And so we're paying out 6% over the course of 2023, but we're investing those dollars in the meantime. And so if we took a typical year, and if we look, Leanne, at the track record of the endowment, which on an annualized basis has produced about an 11% return annually over the last 20 years. So let's assume over the course of 2023 that the endowment returns 10%. Well, in this scenario, we're paying out 6%, but we're growing by a rate that's higher than that. And so that excess 4% of return is reinvested into the CRT. And so now, roughly speaking, when we get to January 1st of 2024, we now are working with a balance of not $100,000, but now $104,000. And so the payout in year 2 is going to be 6% of that higher principal balance of $104,000. And this really, Leanne, gets into the power of this as a planning tool for many families, which is if we are performing in the endowment at a rate that's higher than that payout rate, and again, historically, that very happily has been the case, then year over year, that distribution increases because we're reinvesting a lot of that gain. And often when we run these out for 30 or 40 years, you can really see an exponential increase over time in what a family is benefiting from in the Charitable Remainder Trust. It's also true, we should note, that you're taking on both the upside benefit, but also the downside risk. This is an investment like other investments. And so it's possible, certainly in a given year, that the endowment performs at a rate that's less than what that payout rate is. And so what happens? Well, you're still getting that fixed payout rate, but now it's of a principal balance that has decreased a little bit year over year. And so long term, again, we look at the Notre Dame endowment and what that has done over the years, and very happily, if we take the long view, again, over 20 years or so, that return has been about 11% per year.
Wow, with those great returns, the obvious question then is, how does someone establish a CRT at Notre Dame?
Yeah, so this always begins, these are very personalized conversations. And so myself, a member of our team, would want to talk with you first, make sure we understand what your objectives are for the CRT, make sure we have a chance to walk with you through how it works, what the risks are, what the upside benefit is, answer any questions you might have. And typically, Leanne, what we do is we will prepare an illustration that's personalized and that's tailored to what that family is thinking about. That illustration allows us to pinpoint what that charitable deduction would be in a given month if somebody were to make that contribution. And it also allows us to build in a range of potential investment outcomes. So we, of course, can't forecast and don't know where we'll be from an investment standpoint 5 years, let alone 10 or 20 years out. And so we'll assume typically a range of investment outcomes and walk through that so that the donor understands what it might look like. At this point, as throughout the process, is again a good time for the donors to talk to their advisors, make sure that they're thinking about their own tax situation as they look at something like this. But if everything looks good, then we would create what's called a trust agreement Notre Dame drafts that trust agreement. It's a fairly standardized document. We follow very closely the IRS recommended terms for a vehicle like this. But we draft that, we prepare it, we send it to the donor. Again, we ask our donors to review this with their counsel and with their tax advisors. Once everything looks okay, the donor signs that trust agreement, Notre Dame signs that trust agreement, and away we go. So at that point, the donor can then contribute as they choose, typically, again, either cash or long-term appreciated securities to that trust. And I would say, Leanne, the most common thing that folks will do is use those appreciated securities. And there's a tax benefit of doing that, which is if I were to take appreciated securities that had grown in value since the time I purchased them, and I sell those securities, I'm going to be faced with a capital gain because of the difference in value when I sold them versus when I purchased them. If instead I take those securities and I contribute them to a charitable remainder trust at Notre Dame, we sidestep that immediate recognition of gain. And so there's an immediate income tax benefit in using an asset like that, especially then too from a financial standpoint. We've had a lot of donors that have said, I have these appreciated securities, they're worth a lot, but they're not generating any income for me. They're not dividend producing. And so if you take an asset like that, you convert it to an income stream by contributing it to the remainder trust. And again, we sidestep those immediate gains. I should note here that I said at the outset, there are sometimes other assets that folks will use to fund a CRT. Most commonly, we will discuss potentially real estate as a source of funding a CRT. It has to be owned free and clear, so real estate that's encumbered with a mortgage wouldn't work. Privately held business interests, we also will explore at times. In each of these scenarios, if it's anything other than cash or appreciated securities, then there's a due diligence process that we would want to very carefully walk through. We work with our own general counsel at Notre Dame in those situations. We would certainly, again, want to work with our donors' advisors and just see what's a fit. But one way or another, Leanne, trust is funded. We have assets in the trust. They're invested in the endowment. And we try to keep this very hands-free. So the donors start to receive distributions typically via direct deposit at the end of the first quarter after they've made those contributions. We send quarterly statements as well so they can see the investment performance of the endowment. And then for tax purposes, and we'll talk, I hope, a little bit about the tax consequences of a gift to a CRT and the income that comes from it. For tax purposes, we send a Schedule K-1 every year that reports the taxation that somebody would need to report on their income tax return.
So TJ, what happens to the trust investments when the CRT ends?
Yeah, so this is, for us at Notre Dame, it's a real privilege to us to have these conversations with the families that create these CRTs and just explore with them what they want their legacy to be. And so typically this is not in lockstep in terms of timing as to when they create the CRT, but typically a step that follows it. And so we'll sit down or have often a series of conversations and just ask the question, how do you want this gift to be used at Notre Dame? And so often that is an unrestricted gift, which for the university will always be the most valuable dollar. That's an extremely generous thing when folks choose to do that. But very often what we'll do is we'll work to create an endowed fund or an endowed fund structure that will name in honor of the family that's created that CRT. It'll have a specific purpose, often financial aid, and we'll have that, what's called a fund agreement, ready and waiting, so that when that remainder of the CRT comes into Notre Dame, then we put it to use as the family directs. And in that latter scenario with an endowed fund, that's a legacy that will last forever at Notre Dame.
This is a lot of wonderful information. It can be helpful to see how those numbers break down. We're going to pull up some scenarios on the screen. And TJ, can you walk us through the numbers?
Yeah, absolutely. It certainly does help to take a look at a couple of examples. So as we see them come up on the screen here, I'm going to walk through first a scenario of $100,000, and we'll see this pop up in a moment here. There it is. So assume here a gift of $100,000 to a CRT at Notre Dame. We're assuming in this scenario that this is a married couple, both age 55 at the time that they create the CRT. Because they're 55, they can elect a 6% payout rate. So we're assuming that in this illustration as well. And so in this scenario, you look and you can see there the charitable deduction figure, which is about $17,000. And that, again, is a function of the ages of the donors and beneficiaries at the time that they create the trust. It's a function, of course, of the gift amount. And it's also a function of interest rates that do change monthly, but wouldn't change this deduction in any kind of material way. So this is showing what you would see if somebody made a contribution in November of this year. And so 6% payout rate in this illustration. We assume further a 9% annualized return in the endowment. And what happens is if we run this out for, in this case, 40 years, and why 40 years? Well, that's because if we look at the actuarial life expectancy of a couple at this age, this is what the IRS tells us we would be looking at. And so if we do run this out at 40 years, and we have, again, this scenario where we're growing at a rate in the endowment that is higher than that payout rate, then you can see down in the bottom rows of this illustration, really the incredible effect that a gift like this would have. More than 4 times the amount of distributions would be coming back based upon the value of that gift to the family over those 40 years. And then that last number there, that $326,000, reflects that remainder amount after 40 years that could be dedicated at Notre Dame as a gift. And so, Leanne, if we take this same scenario and we adjust it to now, let's show it with a higher figure as well. If we used a $500,000 figure, assume all of the same things, same ages for the donors and the beneficiaries. We assume the 6% payout rate again and the 9% annual growth rate in the endowment. This is really where it's an extraordinary thing to see what could happen with a gift like this. More than $2 million in this scenario coming back out pre-tax to the beneficiaries of the trust over those 40 years. And then a gift to Notre Dame of more than $1.5 million. And then often, Leanne, what we'll do is we'll take these figures and we'll say, well, this is a forever gift to Notre Dame. So let's look even further and dream about what this might look like 50 years after a trust is ended, or 100 years after a trust is ended. And let's continue to assume, investment growth in the endowment. And it's a special thing, almost hard to get your arms around what that could mean for future generations at the university.
What an impact you can have. Those are pretty powerful examples, and they really show how a CRT is a great opportunity for everyone. Let's turn now to the questions that you, the viewers, submitted prior to the start of the webinar. Okay, TJ, first question. Once a CRT is established, can a person make additional contributions to it?
Yeah, so absolutely. Yeah, so it's really easy. Once the CRT is established, we've done all the paperwork at the outset. Contributions can be made at any time. It's typically via wire transfer or check, or again, appreciated securities as the source of that gift. We also have increasingly now a lot of folks that will say, I like the CRT as a long-term investment strategy, and I certainly like it from a philanthropic planning strategy, but I don't need that income for the next 5 to 10 years. So what can I do in that scenario? And so a lot of times what we'll do is we will set the CRT to auto reinvest those distributions. Now, it's important to note that from an IRS, from a tax standpoint, the beneficiaries are still deemed to have received that distribution. So we still send that Schedule K-1, still reports the full value of that distribution. But we automate that reinvestment so that we're growing now at a higher rate within that CRT. We also have a scenario sometimes where folks will use a CRT, again, often in the short term, as seed money for an annual gift. So I know many Soren Society members are on the call today. A lot of times folks will say, just auto distribute that distribution to the Soren Society. In that scenario, it's just like any other type of gift where that donor gets a full tax deduction for that contribution.
All right, next question. Are the distributions from a CRT taxable?
Yeah, so this is a good question, one that comes up almost in every scenario. The short answer is mostly yes. So I would assume if you're looking at a CRT, just assume that anywhere between 80% and 100% of that distribution is going to be taxed as ordinary income. The calculus of that is a little bit complex and has to do somewhat with the spend rate that's set for all of our endowed funds at the university. And so we could, on a one-on-one basis, walk through that in more detail, but assume mostly yes. And to the extent that you don't have ordinary income, if you've used low basis assets that had some capital gain that was not recognized, then small pieces of that gain will also come back typically as part of those distributions.
In the scenarios that we've discussed, we've assumed that the donors of the CRT are also the beneficiaries of the CRT. Can a CRT be used instead to benefit a donor's children?
Yeah, so it's a great question. So the answer is sometimes yes. I would say the vast majority of our CRTs benefit just the donor or the donor and a donor spouse. There are scenarios where children, most often, if it's not just the donors, children will benefit from a CRT, but a few other factors come into play here that are really important to think about. One is that anytime a non-spouse is the beneficiary of a CRT, there are gift and estate tax consequences that would have to carefully be looked at, again, in consultation with the donor's advisors. And so we'd want to look very closely at that, first of all. The deduction that you receive from a CRT is based upon the life expectancy of the beneficiaries. And so when you've got a younger beneficiary, that lowers the tax deduction. So that's another factor to look at. And then sometimes there are simply beneficiaries that are too young. So we can do a CRT that lasts for a term of years rather than a lifetime, but we cannot extend indefinitely or for a very long time a lifetime CRT just based upon IRS regulations.
Okay, this next question came up quite a few times from our attendees. Can a person contribute retirement assets to a CRT?
Yeah, so again, I'm answering like a lawyer here. It depends, as is the case with a lot of these questions. But yes, so the first thing to note is you cannot make what's called a qualified charitable distribution, or more commonly known as an IRA charitable rollover gift. You cannot make that type of a gift into a CRT. The IRS won't allow it. The code doesn't allow it. However, for a lot of folks that are thinking about a CRT to benefit children, they will often use, and we would recommend using, the balance of an IRA that at death might otherwise pass to children. That's a great source of funding of a CRT and what we would call a testamentary CRT in that case. Again, a lot of factors that we would have to work through to make sure it worked for the family and worked for Notre Dame. But yes, that's the scenario where an IRA could be used.
Okay, we've packed in a lot of information in a short amount of time. Now, finally, how does the rise in interest rates in recent months impact the potential benefits of a CRT?
Yeah, it's a common question these days, and certainly in the inflationary environment, a lot of people are thinking about this. So there's a modest impact in terms of that deduction on the front end. I mentioned earlier on that rates are set every month that impact that deduction. As rates go up, your deduction goes up a little bit, but it's not a material consideration for most folks. It doesn't change the calculus too much. I would say, though, Leanne, your question raises a related but separate question, which a lot of folks will ask us, which is, there's a lot of volatility in the market right now. So is this a good time to think about a CRT? And what I would typically say to that question is, well, one, it depends. It depends on a lot of factors beyond Notre Dame and rely a lot on an individual circumstances. But our investment office approaches the investment in the endowment with a long-term time horizon. And so anybody thinking about a CRT should also be thinking about this as a long-term investment as much as possible, maybe putting some blinders on in terms of short-term volatility. And having confidence, I think well-placed confidence that over the long term, we've got a really well-diversified investment mix in the endowment, and it's going to serve our donors well. So timing is always tricky. I wouldn't overthink it. If it's the right vehicle and the right time from a tax planning standpoint, it may be a great time to do it.
Now, to wrap up, TJ, can you recap the top 3 benefits of establishing a Notre Dame Charitable Remainder Trust?
Yeah, absolutely. So back to the top, really 3 core benefits. One is that participation in the returns of the Notre Dame endowment. Second is upfront tax deductibility. And then third, again, a great way to make or expand a really beautiful legacy at the university.
Okay, for any questions unanswered today, or if someone is interested in establishing the CRT, what do they need to do now?
Yeah, so I think we'll have our information pop up on the screen. It's a great privilege for our team to serve as planning partners for the families that have been so generous to Notre Dame or thinking about a gift to Notre Dame. And so we welcome further questions or conversation around this topic, certainly. But I would say, too, more broadly, we serve a role in our office of being tax planning partners for you and your families. Certainly, we work a lot in the estate realm, and I know we'll have a future webinar talking about the estate topic specifically. It's a great privilege and pleasure for us to be part of those conversations. So we encourage anybody to reach out at any time.
And such an interesting topic. Thank you for your expertise. And thank you, everyone, for joining us today. As we close, we invite you to register for our upcoming webinars, where we hope to provide you with more information and help you plan your Irish impact.